In this video, I'll cover basic profitability metrics and the DuPont decompositions of return on assets and return on equity. In the context of this course, the main focus of profitability analysis is understanding the return per dollar of investment in a company. The main metrics we'll be looking at are variations of return on assets and return on equity. Here is an example of why to use these types of metrics rather than something like return on sales. Suppose you paid $10,000 to buy this video. You earn $1 for each 100 views and pay YouTube a 10-cent hosting fee. During the year, you get 10,000 views, so you have $100 of sales and $10 of fees to YouTube, giving $90 of net income. Return on sales shows a whopping 90% profit margin, which would make many politicians want to throw you into prison. However, return on assets is 0.9%, which is not much better than you would get in a savings account. The 0.9% gives a better picture of the performance of your video venture because it focuses attention on how much you are getting from your investment. You can compare this to other alternatives such as buying treasury securities or a stock market index. In the following examples, we will look at two companies from the video game industry, Activision Blizzard and Electronic Arts, and two companies from the grocery industry, Kroger and Sprouts. The reference sheet posted on CCLE includes these companies' financial statements and provides computations of the ratios. You may wish to pause the video right now to make sure you have these references on hand in case you need to see where I'm getting some of the numbers. Let's first look at return on assets, which is net income divided by average total assets. For example, Activision Blizzard had $966 million net income for 2016. At the start of 2016, it had total assets of $15,246 per the December 31st, 2015 balance sheet. At the end of the year, it had $17,452 of assets per the December 31st, 2016 balance sheet. This gives return on assets of 5.9%. We use average assets to approximate the average assets outstanding during the entire year when the company was earning the net income. Recall that the balance sheet gives the asset value at a specific point in time, while Activision Blizzard is earning the income during the entire year. If we wanted to be really picky, we could even look at the quarterly balance sheet numbers to get an even more precise number. Here we see the return on assets for the example companies. On average, the video game companies have somewhat higher return on assets than the grocery companies. Based solely on return on assets, Electronic Arts is outperforming Activision Blizzard, while Sprouts outperforms Kroger. By itself, the return on assets is somewhat limited in what it tells us about the companies. For example, Activision Blizzard's 5.9% return on assets is very close to Kroger's 5.6%. Does this mean that the companies are similar? Of course not. This is going to lead to the next topic of DuPont analysis, which gives us a window into how the companies are generating their return on assets. As the name suggests, DuPont analysis originated at DuPont Corporation as a way of evaluating business performance. Recall that return on assets is net income divided by average total assets. The DuPont decomposition splits this into two components, profit margin and turnover. Profit margin is net income divided by sales and represents how much income each dollar of sales generates. Turnover is sales divided by average total assets, and it represents how much sales each dollar of assets generates. The product of the two is the company's return on assets. For example, Activision Blizzard's return on assets was 5.9% in 2016. The DuPont decomposition splits this into a profit margin of 14.6% and a turnover of about 0.4%. The way to read this is that every dollar of Activision Blizzard's assets generated about 40 cents of sales, and every dollar of those sales generated about 14.6 cents of profit, giving about 5.9 cents of profit for every dollar of assets. Now let's look at Kroger, which had a similar return on assets of 5.6%. Kroger's profit margin was 1.7%, and its turnover was 3.28. In other words, each dollar of Kroger's sales generates about 1.7 cents of profit, which is much lower than Activision Blizzard's margin. Kroger gets a similar return on assets because its turnover is much higher, generating $3.28 of sales per dollar of assets. While Activision Blizzard and Kroger have similar return on assets, we can see from the DuPont decomposition that they generate it in very different ways. Activision Blizzard generates high profits per dollar of sales, but not much sales relative to its assets. Like most companies in the highly competitive grocery industry, Kroger generates very low profits per dollar of sales and makes money mostly by churning out high sales volume relative to its assets. Kroger's low margin and high turnover is loosely associated with a cost leadership strategy, while Activision Blizzard's high margin and low turnover is loosely associated with a differentiation strategy. This is a typical phenomenon, and companies usually face a trade-off between profit margin and turnover. Here we see the DuPont decomposition of return on assets for our example companies. The DuPont decomposition can help us begin to understand why the companies perform differently. Overall, the video game companies have significantly higher profit margin and lower turnover than the grocery companies. Electronic Arts outperforms Activision Blizzard in terms of both margin and turnover. Sprouts has a higher return on assets than Kroger because of its higher profit margin, perhaps from being a more premium organic grocer. This is somewhat offset by Sprouts' lower turnover. This is not too surprising to me since anecdotally, the Sprouts stores that I've been to have much more open space than a Kroger, which will translate into lower turnover. An extreme example of high turnover would be a Trader Joe's, where it seems like every single square inch of store space has either products or customers on it. While they're not a publicly traded company where we could see their financials, my guess is that Trader Joe's sales turnover is probably extraordinarily high. Now we're going to look at return on equity. Recall that return on assets measures how much a company earns per dollar of assets. Because most companies use some borrowed money, the return on assets does not represent the return to shareholders. Return on equity gives a gauge of how much profit the company generates for the shareholders, relative to how much the shareholders invested. Return on equity is net income divided by average stockholders' equity. Just as we used average assets as the denominator for return on assets, we use average equity as the denominator for return on equity. The reason is exactly the same. Similar to assets, we only observe the amount of stockholders' equity at specific points in time, while companies earn net income over a span of time. This is a typical rule. In ratios that have both income statement and balance sheet numbers, we usually use the balance sheet averages to approximate the balance sheet values over the time span covered by the income statement numbers. For example, we already saw that Activision Blizzard had $966 million net income for 2016. We also saw the computation of its 5.9% return on assets. At the end of 2016, Activision Blizzard had 9,119 equity per the December 31, 2016 balance sheet. At the start of the year, it had equity of 8,068 per the December 31, 2015 balance sheet. This gives a return on equity of 11.2%. Here we see the return on equity for the example companies. Based solely on return on equity, Electronic Arts is outperforming Activision Blizzard, while Kroger outperforms Sprouts. Similar to return on assets, return on equity is limited in what it tells us all by itself. This again leads to the use of DuPont analysis to get a sense of how the companies are generating their return on equity. The DuPont decomposition splits return on equity into three components. The first two components, profit margin and turnover, are defined as in return on assets. The third component reflects the effect of leverage, defined by average assets divided by average equity. For example, we can write Activision Blizzard's return on equity of 11.2% as the product of its 14.6% profit margin, its 0.4 turnover, and its 1.9 leverage. The way to read this is that for every dollar of equity, Activision Blizzard has $1.90 of assets due to the use of liabilities. Every dollar of assets generates 5.9 cents of profit, giving 11.2 cents of profit per dollar of equity. Now let's compare the example company's return on equity through the lens of the DuPont decomposition. Kroger has the highest return on equity out of the companies, and we can see that this is driven by its much higher leverage. The other three companies have about $2 of assets per dollar of equity, while Kroger has more than $5 of assets per dollar of equity. While Sprouts has higher return on assets than Kroger, it has lower return on equity. This is because Sprouts has a low leverage level, similar to that of the video game companies. Activision Blizzard and Electronic Arts have similar leverage ratios, so their return on equity differences are driven almost entirely by differences in return on assets. The last thing I want to cover in this video is the distinction of return on common equity versus the return on total equity. Kroger is the only one of our example companies where there is a difference between the two. Looking at Kroger's balance sheets, we see that its stockholders' equity consists of common equity that corresponds to Kroger's traded shares and non-controlling interests in Kroger's subsidiaries. Similarly, we see that some of Kroger's company-wide income is attributable to non-controlling interests. When computing return on assets, always use the total company net income. When computing return on equity, use total net income for return on total equity and use net income to common shareholders for return on common equity. This wraps up the video on basic profitability analysis. The next video covers an alternative decomposition of return on equity that does a better job of highlighting the effects of leverage. This will take your financial statement analysis skills from this to this.